Since 1973, the Financial Accounting Standards Board, FASB, has been the designated organization in the private sector for establishing standards of financial accounting that govern the preparation of financial reports by non-governmental entities. Those standards are officially recognized as authoritative by the Securities and Exchange Commission, the SEC in Financial Reporting Release Number 1, Section 101, and reaffirmed in the SEC's April 2003 policy statement, as well as by the American Institute of Certified Public Accountants in its Rule 203, Rules of Professional Conduct, as amended in May 1973 and May 1979. The FASB standards are important to the efficient functioning of the economy because decisions about the allocation of resources rely heavily on credible, concise, and understandable financial information. The SEC has statutory authority to establish financial accounting and reporting standards for publicly held companies under the Securities Exchange Act of 1934. However, throughout its history, the Commission's policy has been to rely on the private sector for this function to the extent that the private sector demonstrates the ability to fulfill a responsibility in the public interest. Russ Golden is the current chairman of FASB. He was initially appointed to the board in 2010. Prior to being on the board, he was technical director of the FASB from 2008 to 2010, at which time he also chaired the FASB's Emerging Issues Task Force. From 2004 to 2007, he was a senior technical advisor to the board. Prior to joining the FASB, Mr. Golden was a partner with Deloitte & Touche in their national office in their accounting services group. In this presentation to a group of senior financial executives, Mr. Golden talks about the FASB's strategic direction and future agenda.
It's a pleasure to be here today. I've had the opportunity to speak here a number of times, and it's also a pleasure to see all of you and people that I've known for years. It was great. I saw Leslie, former chair of the FASB, at the breakfast place. She'll probably be embarrassed that she was, I said the breakfast place. But I hear Bob is here, but I haven't seen Bob. Bob, are you here? There's Bob. Hey, good to see you. This is the old reunion, right? I really have to give credit to Leslie and Bob. A lot of the things that we're able to have successes for in the past year and the coming year really were because of the leadership of Bob and Leslie. And while they started this quest, it is something that we're able to end, but it's always been a team effort, and we always, when we finalize things, we like to congratulate not only the team at the board at the time, but the team that has been there that brought us there. So I think what I'm going to do today is I'm going to talk about the strategic direction of the FASB, talk about the future agenda, talk about the simplification initiative and how sometimes it's not so simple. And what we can do to do better. And then we're going to pause for your questions. So with respect to the strategic direction, we've had a lot of major successes with the ISB. We were able to minimize differences and really converge on revenue recognition. And if you think back where we were 10, 12 years ago, we were in a situation where U.S. GAAP had a number and a lot of different models and principles associated with revenue recognition. And the ISB had very few. And so we were able to come together and I think build a very strong foundation so we can have consistent application of revenue recognition across the world. Now, we're not exactly the same. There are some differences, and we're working very hard through the implementation phase to remain converged, and we'll talk a little bit about that. Now, I think leases is a major success because we are both agreeing to put the assets and liabilities associated with leases on the balance sheet. Now, we have a little difference of opinion as to how the performance statement will work, but the main objective in my mind was to appropriately reflect the obligations and the rights in the balance sheet, and we have come to agreement on how to do that. We've had major successes in the business combinations, and we'll talk in a minute about how we are remaining and attempting to remain converged on that, non-controlling interest, stock compensation, and fair value measurements as well. So where do we go from here? When I look out, and we're on pace to finish a lot of these projects we've been working on a number of years. That would include leases, impairment, and classification and measurement. So where do we go from here? I think the FASB we should continue to improve GAAP when necessary for U.S. stakeholders. It is the U.S. stakeholders that give us our authority, and we need to recognize, in essence, you and the users of the the information for the capital markets, in essence, as our customers. So we need to continue to stand ready to make our product better when we can make it better. We need to try to keep converged standards converged. I believe there's a benefit to having converged standards. I believe there's a benefit when investors are investing across markets. And I also believe there is a benefit to you all. There is a greater cost when we don't converge. And you all know that, and we know that. And so I believe it's important that as the board members try to converge, we think about the benefits and we think about the cost of not converging. Now, that doesn't mean that in every single situation we will agree, but I think when we don't agree, we need to be able to articulate why we think the cost of not converging is okay in relation to the cost of converging. And we started to talk about that. And part of the reasons why that may occur is there are different laws in this country than other countries. There's different regulatory environment. And so, and we'll get to this in a minute when we think about the revenue recognition and the implementation, why we were unable in certain minor cases to stay converged, and how we evaluated the cost of being different for you all in relation to the benefit of converging. I think we need to have a culture of simplification, and we need to try to make it as simple as we can, recognizing that ultimately we need to do what's in the best interest of investors. We need to support during implementation. I think the revenue recognition TRG has been a great success. I know a lot of people want to be critical and say there's been 80 issues that have been brought to the board, and that is a situation where perhaps there was a flaw in the process. But I think that when you look at it, just about every company has had to evaluate revenue recognition. And when you look at the 80 questions that have come to the board, come to the TRG, only 5 or 6 have actually risen to the board level. And I think it's important that the board create an infrastructure in place so that you all, your auditors, and your users can have a frank discussion about what is the most effective way to implement. When I introduced the TRG, I said there would be 3 objectives. The first would be education. And I think it's been very successful in educating our stakeholders on what the board intended. By far, the majority of the questions that come to the TRG, they are discussed, and there is a consensus built at the TRG that there is no need for formal standard setting, that there is just a better understanding of what the board intended. I talked about how there may need to be some technical amendments to make it more cost effective, and a couple of those have occurred. For example, gross versus net for sales tax. The way we had written the standard, the companies in here that are predominant retail, you'd have to go to every single state, county, town, and do an analysis as to whether or not you'd have to do gross versus net. And we recognize that that's not really what we thought we were doing in the original cost-benefit discussion of that particular technical discussion. So the FASB, in essence, unwound that and said it can be a policy decision. That was one where we were able to reduce costs, and I think not really impact the benefit to investors. I don't really think there are investors making buy-sell decisions based on the gross versus net of a retailer for sales tax. And I also talked about in the TRG that there may just need to be some interpretations. We know that there'll be disagreements. There are very prominent professionals that look at revenue recognition and look at this on a daily basis, and sometimes they disagree. And we need to reduce the diversity when the diversity could impact investors. And there's been a couple of things that we have started and we'll be finishing. We do plan to have a TRG for impairment. When we issue the impairment, we think that there could very well be questions. And again, we want to educate our stakeholders on what the board intended. We want to potentially stand ready to make amendments if necessary to reduce the cost of application, providing we don't impact the benefit. And there could be some disagreements in the implementation, and we'll stand ready. At this point, we are not creating a TRG for the leases project, and the fundamental reason is we're not making, while it would be a substantial change to the balance sheet, we're not making that many difficult changes to the technical interpretation, the technical judgments necessary for leases. We are in leases making some changes around the definition of a lease, but the other types of things as far as what would go into the obligation are very similar to what you have today. So at this point, we don't see the need to create a leases TRG. We're committed to education. We think it's very important that that we can facilitate and promote education of what we're doing, and we've started to, in essence, train the trainers. It's not feasible with our resources to actually have an educational arm, but we stand ready to help those who do have the infrastructure to educate. And we are committed to improving the codification. Recently, we issued a new change of the codification to allow you all to, in essence, tailor the codification for your specific facts and circumstances. That will make, we believe, the codification much more user-friendly.
International convergence of accounting standards is not a new idea. The concept of convergence first arose in the late 1950s in response to post-World War II economic integration and related increases in cross-border flows. Initial efforts focused on harmonization, a process to reduce differences among the accounting principles used in major capital markets around the world. By the 1990s, the notion of harmonization was replaced by the concept of convergence, the development of a unified set of high-quality international accounting standards that would be used in at least all major capital markets. The International Accounting Standards Committee, formed in 1973, was the first international standard-setting body. It was reorganized in 2001 and became an independent international standard setter, the International Accounting Standards Board, IASB. In September 2002, the FASB and the IASB met jointly and agreed to work together to improve and converge U.S. GAAP and IFRS. That partnership is described in the Norwalk Agreement issued after that joint meeting. The Norwalk Agreement set out the standard goal of developing compatible, high-quality accounting standards that could be used for both domestic and cross-border financial reporting. A lot has happened since then with regards to convergence. The FASB and IASB have been working together since 2002 to improve and converge U.S. GAAP and IFRS. As of 2013, Japan and China were also working to converge their standards with IFRS. The SEC consistently has supported convergence of global accounting standards. However, the Commission has not yet decided whether to incorporate international financial reporting standards into the U.S. financial reporting system. Now, let's return to Russ Golden's presentation to learn more about the FASB's current vision with regards to convergence.
So our vision of the future is we believe that there needs to be a long-term global standard-setting environment in which the FASB, the ISB, and other major capital market standards coexist and, Sue? Yeah. I have a little speech impediment. Honestly, in first grade I had to go to class because my name was Wuss. So I've learned how to say Russ, but I don't know how to say that word. It's cooperate. That's the best I can do. And by the way, the PR guys get frustrated when I do that. Coexist and work together with the goal of issuing converged standards. Again, as I said before, we think there is a benefit to issuing converged standards, and we think there is a cost when we don't issue converged standards, but we have to stand ready to address the specific needs of the capital markets to which we serve, and ultimately that's what's going to drive our vision. So we think there's really four things we can do. First, we need to continue to develop GAAP. We need to actively participate in the development of IFRS. We need to enhance relationships and communications with other national standard setters. And that is all because we need to work together with the international community on individual projects and best practices. There are a lot of great minds across the world. And when I get to our future agenda, these are all issues that we've all talked about for a number of years. And there's been some great content development, some great forward thinking, both in the U.S. and outside the U.S. So we need to work together to try to arrive at the best possible solution. And we need to continue the commitment to reduce differences and promote convergence. So as we complete these projects we've been working on for a number of years, now is the time to start thinking about what is the future agenda of the FASB. And so we started the process by seeking input from all of our advisory committees. And what we asked them sounds simple, which is, what are the most needed financial reporting improvements and why? What are the feasible solutions? And when is this solution needed and for whom? So in essence, what we're asking people, and I'll get to the point where we're going to ask all of you, is what is the problem? Is there a feasible solution or solutions to the problem? And is it a priority problem? One of the reasons why these important projects that we're able to complete in the next few months have taken so long is because the board, I believe, identified a problem, started on the project, but hadn't fully identified feasible solutions. Or we identified too many problems and didn't prioritize. And when you all know this from your organizations, when you try to tackle too many things at one time, you end up in a situation where you're unable to complete any of them within an effective period of time. So we're going to ask simply, what is the problem? What are solutions? And is it a priority problem? So the next slide, we talk about what were some of the results of the survey. So when you look down the left column, all of these are things that you've probably been talking about throughout your career. Financial performance reporting. Almost every stakeholder recognized that financial performance reporting could be improved. Now, they have differences of opinion on how you improve it, but they all think it should be improved. Improving cash flow classification. Improving cash flow classification. We'll go on the next slide. So this is really more of a summary of the prior one, but this takes it by the preparer, the user, the practitioner, and other. And others are attorneys, academics that are on our various advisory groups. But all across the board said we should improve financial performance reporting. So the board has asked the staff to think about various ways of improving financial performance reporting. One could be better disaggregation on the accrual statement. It could also be better disaggregation plus subtotals. A lot of people say, well, maybe we should have operating income. Maybe we should have recurring versus non-recurring income. And so what they're looking at is those common non-GAAP measures that are used that drive the market to determine, can we improve the performance statement? Next, all of our stakeholders said we should improve the cash flow classification. Now again, this varies. I think users would say the best way to do that is the direct statement of cash flow. I recognize this is unscientific, but how many of you in this room would raise your hand? I didn't raise my hand either. But other ways I think we could improve the cash flow classification is perhaps today the operating cash flow is the residual. Perhaps it shouldn't be the residual. Perhaps we should define operating cash flow and make another category the residual. Now that may not impact manufacturing companies, but it could have a very strong benefit to financial institutions. A lot of times when you look at users, they say the cash flow statement is not used because what is, in essence, their operations is not within operations. Pensions and OPAPP, it's constantly evaluated as something we should improve. I personally agree it should be improved. Where I challenge the board is it a priority project? Is improving pensions and OPAPP more important than improving liabilities and equity? The board does not have the capacity to add all of these projects at one time. We probably only have the capacity to add 3 or 4. And so I'm going to ask the board at the end of all this research, do you agree with the problem? Do you agree with potential solutions that we can address? And do you believe it's a priority? So that we can weigh and consider, is pensions and OPAPP, the challenges and the problem we have there, more important than the challenges and problems we have in liabilities and equity? With respect to pensions and OPAPP, I agree it's a problem. But when I look at the trend of pensions and OPAPP, and I forecast how long it'll take to finish and the effective date, I'm not sure the economic phenomena that we have today in pensions will be there by the time of the effective date. And I guess that leads me to, I probably should have said this at the beginning, but again, these are my views and only my views and don't necessarily represent the views of the board. So now that we have the results of the survey, the question is, what do we do with this information? Well, the staff is actively working on a discussion paper. Well, we will put out and ask you all what you think about the board and our advisory committee's identification of the problems, of the solutions, and of the priorities. And we'll take all of that information and we will move forward. And the next slide talks about the key dates. We hope to have the DP issued in March, towards the end of your busy season, give you plenty of time to think about it. We expect to have roundtables across the country to have a discussion about this. But if things go well, sometime in the second half of 2016, to identify what will be the significant priority projects of the board going in the future. That will give us time, and we'll have allocated time on our agenda to stand ready for implementation questions, implementation process for impairment leases. It'll give us time to continue to actively work on the hedging project, but it'll give us time to lay the foundation for what may be the future priority projects.
The FASB has launched a tightly focused initiative to make narrow scope simplifications and improvements to accounting standards through a series of short-term projects. The projects included in the initiative are intended to improve or maintain the usefulness of the information reported to investors while reducing cost and complexity in financial reporting. In addition to the simplification initiative, the FASB recently completed several projects and currently is working on several projects that are intended to reduce cost and complexity in financial reporting. As part of its simplification initiative, the FASB added the following narrow scope projects to its agenda. 1. Balance sheet classification of debt. This project is expected to reduce cost and complexity by replacing the existing fact pattern specific guidance with a principle to classify debt as current or non-current based on the contractual terms of a debt arrangement and an organization's current compliance with debt. 2. Accounting for income taxes, intra-entity asset transfers. In January 2015, the board issued an exposure draft of a proposed update, which is expected to simplify accounting for income taxes by eliminating the prohibition on the recognition of income taxes for transfers of assets from one jurisdiction to another. 3. Stock-based compensation. This project is intended to make some relatively narrow simplifications and improvements to accounting for stock compensation to employees. 4. Equity method of accounting. In June 2015, the board issued an exposure draft which is expected to reduce cost and complexity by doing the following. Eliminating the requirement that an entity account for the difference between the cost of an investment and the amount of underlying equity in net assets of an investee, as if the investee were a consolidated subsidiary, and related disclosures, as well as eliminating the requirement that an entity retroactively adopt the equity method of accounting if an investment that was previously accounted for on other than the equity method becomes qualified for use of the equity method by an increase in the level of ownership interest. Now, let's return to Russ Golden's presentation to learn more about the simplification initiative.
So simplification and lessons learned. I think we've done a lot of good on promoting simplification. What we attempted to do in simplification is we wanted to reduce the cost and complexity while either maintaining or improving the usefulness to information to users. We view these as narrow scope things that we could do in 1 to 3 meetings. And what we found is it's not so simple to do that. And the reason it's not so simple is because sometimes the outcome matters. There's been ideas that we've had that I believe are very simple. However, it gives a result that is not as favorable as the result today. So what we've observed is sometimes the market prefers the more complex accounting when it's a favorable result. And one example is debt classification. This is the situation where you renegotiate your covenants that you violated subsequent to year-end, but prior to the issuance of the financial statements. So we had originally thought, well, let's get rid of the Type 2 exception to that, or Type 1 exception to subsequent events, and just say, show it as current because you violated your covenant, disclose that you had a waiver. Now, some of the former board members, I think, that had lived through this attempt a few years prior, called us privately, and this is always helpful to say, Are you sure you know what you're doing? I should have listened to their advice, to be honest with you. But what happened was it was quite clear that preparers, specifically small business and private preparers, wanted the more complex accounting because it was a better result. We also found out that sometimes what seems simple actually is more costly, and this is the intra-entity tax transfers. And so in those cases, we've decided to do more research. But I think the real benefit of the simplification initiative is the actual cultural evolution at the board, that the idea that simplification can be carried through to all of our projects. Is there a simpler way to facilitate the accounting or the improvement of financial reporting? And I think that we've been able to make some changes. I talked a little bit about the sales tax issue. I think that's a simpler way for you all to provide the information to investors. I think that what we've done on leases and impairment, I think it is a change, but it is a simpler change. And I like to say, I think what we're doing in leases is the simplest way to put assets and liabilities on the balance sheet. But we've had some very good successes, and I'm very glad that we did this, and I'm glad that we're going to continue to do it. Here is some examples of some of the things that we've done. But we are running low on future ideas about simplification. So if there are ideas of areas you think we could simplify, please let us know, and we'll continue to promote simplification. But we'll only promote simplification if it does not impact investors' information that they receive. So that concludes my prepared remarks. I'm happy to answer any questions before I leave the stage.
Well, Scott, we've got a couple. So I guess first related to just the convergence area in general. You've mentioned you've had some successes in the past. You've had some other projects that haven't necessarily been as successful. And under the MOU plan, you've had a real mandate to try to stay converged. So if you think about going forward without the MOU, how successful do you really think you can be staying converged? Do you think both boards are going to be really engaged in it and try to own it? Or do you see a bit of a parting?
Well, I think it's important for those projects where we have achieved convergence to stay converged. And there is some board members that think we should amortize goodwill, and other board members who think we should not. But in the end, what we agreed to do was to converge our goodwill impairment to that of the ISB. So take away your favorite step 2 analysis. I think that what it does is it takes a commitment from both boards and to understand what is the necessary improvement in our various standards, to understand what would be the cost in the various cultures that we operate. We all know that our regulatory environment in this country is different than other countries' regulatory environments, and we predominantly serve this country, so we have to recognize that. But I don't think we should use it as an excuse. I think we should use it as an opportunity to be able to explain to the various capital markets what we are attempting to do and why. And that is why we've tried very hard over the last year and a half to really enhance our relationships with various standard setters around the world, as well as standard setters, as well as the ISB. We had a very successful joint meeting a couple months ago. We do plan on having at least one annual joint meeting face-to-face, as well as other joint meetings via video, so we can continue to have a dialogue between the two boards.
Okay, thanks. On the agenda, you mentioned a lot of great work that you're doing to try to prioritize those items. If you think about the survey that was sent out, to some extent it was structured. I mean, there was a list of projects, and you asked your constituents to prioritize, and then went from there. So to some extent, it was a bit of a predefined. How do you get a feel for whether those topics are really in need of fixing rather than just their priorities? Are they real priorities that you need to address? You know, and if I look at some of the recent projects you've worked on, to a large extent, you're working yourself back to kind of the existing framework in some of the financial instruments, leases with the exception of on balance sheet. So how do you get a feel for whether something's really broken or whether it's just you got a number of people out there that would like it to change?
So the way the survey started, those of you that aren't part of our advisory committees, is we put 15 or 16 ideas in the survey. And these ideas came from the board members. They came from stakeholders. They came from our simplification initiative, where we looked at things and said this is going to be more difficult than a 2 or 3 meeting. And we wanted to kind of use it as a funnel. So start with 15 or so items, use the survey to narrow it down. So the discussion paper could have maybe 7 or 8 items. And then from there, narrow it down to what is our actual priority projects. In the discussion paper, we'll be asking various stakeholders, what is the problem that you observe, and why do you think it's a priority? We'll be going and hosting meetings around the country and asking the same item. And what we hope to hear is some similar coalition around the problems and the priorities and the potential solutions. But this is a new exercise, and consistent with when I say we're talking to other stakeholders about best practices, this is something the ISB has done for a number of years, and they've been very successful at using this as a way to identify their priority issues. And so we're in essence learning from what they've done and trying something new so that we can identify the problem and identify solutions and prioritize the problem.
Okay. Do you have time for one more?
Sure.
Okay. There's a few questions here that deal with the financial performance reporting project, and let me kind of throw them all out there and then let you address them as you want. So I guess the first one relates to, you know, you've addressed financial performance reporting in the past, and that was not necessarily successful. You got a lot of feedback on that, and maybe the learnings from that will help in this project. So number one, how do you think you can be successful this time around in light of what happened with the last time? And then more specifically, as you get into that project, a lot of comments around the key performance indicators. So, you know, EBITDA, free cash flow, other items that are used, non-GAAP measures. A lot of people see a lot of value in those, in their ability to really communicate what matters to the particular company management and their investors. How do you dance around that in terms of, if you're going to really try to get at those non-GAAP measures, does that go a bit at odds with how people view their use today as very specific management view and particular shareholder view as to what's important to them?
Well, I think the financial performance reporting, I think it's always important to learn from the past. I think one of the challenges the last time we looked at this was that we did both the accrual statement and the cash flow statement at the same time, and we did a very controversial approach to the plan at that time was to require the direct statement of cash flow. And so we're looking at what were the controversial items to determine if we should continue to do that or do something else. I think that on the financial performance reporting, we're asking the staff to look at what are common non-GAAP measures and to look at should we or should we not try to minimize those non-GAAP measures in the performance reporting. A lot of the non-GAAP measures are about recurring income, recurring cash flow, operating income, operating cash flow. Also, investors like to have more disaggregation. We were able to do an XBRL search, and it's quite clear that financial institutions have more disaggregation than other organizations. And so we're trying to determine is it an improvement just required more disaggregation, more line items in the performance statement. And I think there's some board members believe that we should not touch financial performance reporting. Some board members think we should do it, but only focus initially on more disaggregation and line items. And other board members think we should go further and do more line items, more subtotals, more roll forwards of disclosure. So we don't have a firm coalition at the board yet, and that's why it's so important to get the input and really confirm the problem, think about solutions and think about priority.
Okay.
So, okay.
Thank you, Russ.
Thank you very much.